Most trend lines you see on a chart, yours and other traders, are drawn on noise. They connect two random pivots, look reasonable, and break almost immediately when price reaches them. The trend line that actually holds, the one institutions defend and that swing traders can trade off, has very specific requirements that most retail traders never apply. Today, the rules for a valid trend line, the trap of drawing them on noise, and how to use horizontal level confluence to confirm the lines that matter. Here are the three rules. 1. A valid trend line requires at least 3 touches. 2 touches define a line, 3 define a trend. 2. Each touch must be a real swing pivot, a clear high or low where price reversed, not an intraday wick or a single bar test. 3. The highest conviction trend lines coincide with a horizontal level at one of the touches, giving you confluence between the diagonal and a flat support or resistance. Without all three, you've drawn a line, you haven't found a level. Here's the typical mistake. You spot 2 pivots on a chart, draw a line connecting them, and treat it as a tradable trend line. The problem, any 2 pivots can be connected by a line. There's no information in 2 points, it's just geometry. The third price test is the moment the market either confirms the line or breaks it. Without a third touch, you don't have a trend line, you have a hypothesis. Trade hypotheses and you trade noise. Here's the key statistical insight. 2 points define a line in geometry but tell you nothing in markets. A third touch is the market's confirmation that the diagonal level is real, that participants are actually treating that price as meaningful support or resistance. Most professional traders won't act on a trend line until the third touch confirms it. That delays your entry compared to the textbook playbook, but it eliminates the majority of the failed line losses that drain accounts. Now the high conviction version. A trend line with 3 or more touches and a horizontal support level at one of the touches. That's the confluence. The diagonal and the flat agreeing at the same price means institutions are defending that level from multiple structural angles. Trade entries off the third or later touch stop just below the level, target the prior swing high. Defined risk, math-based target, and you only acted after the market gave you 3 confirmations. On a real chart, scroll through any liquid stock and apply the 3-rule test. You'll find that out of dozens of lines you could draw, usually only 1 or 2 qualify. That's the point. Trend lines are not a chart cluttering exercise, they're a high conviction filter. The few that pass all 3 tests are the diagonal levels worth trading. Everything else is just lines, drawn for the comfort of having drawn something. Quality, not quantity. So, a valid trend line needs 3 or more touches at real swing pivots, and the highest conviction lines coincide with a horizontal support or resistance at the touch. Most charts have only 1 or 2 trend lines worth trading. Stop drawing every diagonal you can. Start drawing only the ones the market has confirmed. Subscribe for the full method and trade your own plan. Education, not financial advice.